Joining us now is Ed Mills, Raymond James Washington policy analyst. Ed, who particularly wins here, and how much of it is in the drill, baby, drill arena or other areas that we've heard the president talking quite a bit about?
Yeah, so John, what you referenced there's a provision in here that if you want to get a permit as a fossil fuel company, you can pay 1% of the CapEx, and it's going to come to you in 60 days. So that's a winner. I think that defense is going to be a winner here because there's going to be as much as $300 billion appropriated over the next couple of years for the Department of Defense in immigration. You look at private student loan providers. They're going to be a winner because there is a pullback in what the government's going to do. I look at restaurants, no tax on tips. That's going to draw a lot new talent into the restaurant industry because it goes up to $160,000. So I do think there's a lot of concern in the market about how much of a stimulus this is going to be, how much it adds to the deficit, but always also focus on the fact that there's going to be a lot of winners in this bill.
Ed, I wonder to what degree education, you mentioned private student loans, could be a discussion point or even a flashpoint in the Senate, given not only the pullback in government assistance there, but also this endowment tax that's a part of this. It's going to hit some educational institutions that might surprise some people. And then this new tax shelter around vouchers and the ability to get a 100% tax credit contributing to those. We don't talk about that so much, but to what degree do you expect that to be controversial?
Yeah, John, I do think that when I look at what the Senate's going to do, it's going to make changes, and there's going to be material changes. I think where I'm going to see the most change is some of the provisions related to the Inflation Reduction Act. There are massive additions to this bill that really cut back on the IRA in the manager's amendment in the last 24 hours. I don't think those pass in the Senate. I do highlight to a lot of clients here at Raymond James, the calculations that they're going for the college endowments seem punitive. This seems like a fight against Harvard, something that the president has absolutely taken on. I do think that calculation change, that 21% tax, that has a chance of coming down. I'm not sure if there's going to be massive changes to the way in which the student loan provisions are structured because a lot of Republicans look back to 2010 and the student loan programs were largely nationalized in a different reconciliation bill. And there's a feeling in D.C. that has contributed to so much inflation among college costs and a really big impact to the federal government's budget. So those absolutely stay, John.
So, Ed, let me make sure I got this right. Next step, this bill goes to the Senate. It gets worked through by the senators. If there's changes, it then goes back to the House. Lawmakers from both houses work through this to then pass the final version of this bill. The bond market is definitely gyrating right now because the expectation is you're going to see more spending, whatever happens in the Senate. You're going to see more spending. You're going to see fewer cuts, and that's going to mean more Treasury issuance. The flip side of this is that potentially you could also see a stimulative aspect to this for consumers and businesses because of some of these things you've laid out. Which one matters more, and how much hinges on the Senate?
So, Morgan, the way we've talked about this at Raymond James is May was for the House, June is for the Senate, July is to work out those differences, and August is to get this to President Trump's desk. The binding constraint here is we need to lift the debt limit. And when you talk about the bond market, I think that they have included the debt limit in this because they didn't want to raise the debt limit, have a negative bond market reaction, and then not be able to do as much as they wanted to do. When I look at this bill, Morgan, this is the most expensive bill by dollar amount in the history of the United States, potentially by a multiple of 2 or 3 times. The stimulative parts of this bill are front-end loaded. In the House bill, a lot of these provisions end on December 31st, 2028. I don't think I can find a single person in D.C. that think they will actually end on December 31st, 2028. And so a $1 trillion provision over 3 years, you might actually have to score it as 3, 4, or more $1 trillion over 10 years when you factor in inflation. So this bill, the total dollar amount, I don't know exactly what that truly will be over the next 10 years. The bond market might be the only thing that can get the Senate to pare it back. But when I polled investors at Raymond James here today, only 40% said a negative bond market reaction is going to stop the Senate from paring back what has already passed the House, Morgan.